Hello, welcome to another exciting episode of Invest with Kevin. Today we're going to talk about how credit cards work. A credit card is simply a short-term loan. Think of it like when you go to Chipotle with your friend and you don't have the money to pay for a meal. So you borrow $12 from a friend in order to buy a meal and a drink. Naturally, you're going to pay your friend back once you have the money. Credit cards work exactly in the same way. So when you go to a store and use a credit card to buy something, you are effectively borrowing money to buy the good or service that you are purchasing. You actually might have the money to buy the good or service you are buying, but you simply use a credit card to complete your purchase with the intention of paying back the credit card company at a later date. That is fine. I do that all the time. I buy stuff that I would normally purchase and then pay off the entire balance on my credit card before the due date. Remember, credit card companies are out to make a profit. So if you don't pay off your credit card balance by the due date, they will charge interest on the amount you owe them. Interest is a fee the credit card company charges you for using their money, and if you're not careful, interest could increase your credit card debt. The interest rate on the credit card is known as the annual percentage rate, otherwise known as the APR. This annual percentage rate could range between 15% to 36%. These rates are variable and will change over time. This means if you borrowed $100 and you don't pay it back in a timely manner, you would have to pay potentially between $15 to $36 a year on your credit card balance as interest payments alone. That is assuming you don't make any payments to reduce the $100 debt you owe to the credit card company. Interest payments will not reduce your credit card debt, but you don't have to pay interest as long as you pay your credit card balance off in full before the due date. You see, when you buy something with a credit card, there's a grace period between the date of purchase on the card and the due date listed on the statement. During this time, if you pay your bill off in full before the due date, then no interest charges are due. I recommend everyone get in the habit of paying their credit card balance off in full before the due date. I always pay the entire balance off before the due date, and I can tell you this, it will raise your credit score, it will increase your happiness, and will result in stronger finances. Credit cards are completely safe as long as you make the minimum payments on time. You don't want to miss any payments on your credit card debt to the credit card company, because missing payments on your credit card debt will impact your credit score and cause it to drop. Consequences of having bad credit can include being denied loans for home mortgages, auto loans, business loans, and in some cases you can even lose out on job opportunities. That's right, bad credit can actually hurt your chances of finding another job, especially if that job involves managing money. Think of it from an employer's perspective. They're hiring someone to manage their money as, say, an accountant or a financial manager. Why would they want to hire a person who has bad credit and can't even handle their own finances to manage their money? I mean, it doesn't make any sense from the employer's perspective. And not to mention, you're also a risk factor. Because you have, bad credit, which means you most likely owe money and you're late in your debt payments, perhaps maybe you'll be tempted to steal their money, the business's money, to pay off your personal debts. And that's kind of why bad credit can hurt your chances of getting a job, especially one that involves managing money. And also, another consequence of having bad credit is simply this. Because you have, low credit score, which means you're less likely to pay off your debts or you're going to be late a lot, oftentimes if you do qualify for a loan, you're going to have to pay a higher interest rate, which means borrowing money to buy a car will be more expensive. Borrowing money to buy a house will be more expensive. So it's going to hurt your budget too because of the fact you have bad credit. Now on the flip side, if you are making your payments on time to the credit card company, then you will boost your credit score, which improves your chances of qualifying for a mortgage, an auto loan, business loan, and getting jobs where a credit check is required. Not to mention, you'll also qualify for lower borrowing costs, which means you'll save money because you won't have to pay as much interest because of your good credit score, which will entitle you then to a lower interest rate on a loan. Other things to be aware of when you choose a credit card, look for rewards programs. For instance, like with the credit cards I have, I get cash back, which means for every dollar I spend, I get 1% cash back on my purchases. And that cash back is just points, you see. So for every dollar I spend, it's 1 point. And once I get enough points, I can then cash them in for rewards. Those rewards include benefits such as gift cards to nice restaurants like Olive Garden, or sometimes I can use the cash back to pay off my future credit card balance. I can use the reward points to pay off my future credit card balance without using my own money. And sometimes credit cards come with different perks. Like some people when they sign up can get free airline miles, which can get them free travel. Another consideration to keep in mind when you're deciding to choose a credit card is if it offers a promo APR, a promo annual percentage rate. That's pretty much when a credit card company for new customers will tell the new customer, if you get this card, we'll charge you a lower APR than the other customers for a period of 90 days. And then after 90 days, you'll have to start making payments at the normal APR we charge everybody else, which can range between, say, 16% and 36% a year annually. Now, I have a story about this. So when I got my second credit card, I got a $1,000 credit limit from Wells Fargo years ago. And as a result, they told me this at the time. They told me that I had a 0% APR for the first 90 days, which means I'm going to pay 0% interest for the first 90 days I have the credit card, and I don't have to make any payments for the first 90 days. But after 90 days, if I have an unpaid balance, they're going to start making me make payments, minimum payments on that debt in order for them to make money finally. Now, I'll tell you this, that entire time I had that credit card with that 0% APR for 90 days, and I didn't make any payments, I still made payments. The way I treat credit cards is this. Only spend money you can afford to, spend, and only buy things you can normally, you normally buy anyway. Don't be tempted by the idea because you have a $1,000 limit. I'm gonna go crazy and go buy a bunch of pizza to feed your friends, or go out and do something crazy, like, I don't know, go to a casino and use that credit card like crazy. Because you don't want to have an unpaid balance, especially if, say, for instance, like $1,000. That could take a lot of time for someone to pay back. Especially when you have to pay 16% to 36% interest. And let me tell you this, these banks are smart. They're slick. They think, they know what they're doing, because there's probably a lot of people who get those cards, find out they have to pay anything for, say, 90 days, and they run up a balance, they don't make payments, and then when the bill comes due, they realize they made a big mistake. So don't ever fall for that. Even if your credit card statement says you owe $0, just pay off the balance you have on the card. That's how I do it. Like that credit card, I pay it off each month. Even if I see it says $0 owed because of the grace period, I pay out the outstanding balance every time. Just do that, and you won't ever have to worry about interest charges, and you'll keep your credit card looking good. That's one of the components of the credit score is how much of your current, debt limit you are using. The lower percentage of your debt limit you're using, the better for your credit score. Another thing to be aware of is that some credit cards have annual fees that you must pay each year for the privilege of having the card. Now, in some cases, the annual fee may be worth it. If you, for instance, say you're getting enough benefits to justify the cost each year of having the card, for that annual fee. But you'll have to do the research yourself and compare and see if you're getting enough rewards or benefits to justify the cost of paying an annual fee each year to have a credit card. I mean, there's plenty of credit cards out there that they don't, charge annual fees. I have two myself, and they don't charge annual fees. I mean, maybe in your situation, it may or may not make sense, but you'll have to decide for yourself. Another thing to consider is this last point I'm going to bring up when you decide to, to choose a credit card. This will almost apply if you already have, debt, like say credit card debt you already owe. And this will be something to consider. If the credit card, for new account holders would allow you to transfer your balance from your, other credit cards to the new card. And oftentimes with these balance transfers, these companies are eager to get your business, so they'll let you transfer your balance to them and sometimes pay an introductory APR of 0%, which means no interest for, like, say, a short period of time. But then after that, they're going to start charging, interest on any unpaid balances after the introductory period expires. So let's say you owed $5,000 in credit card debt. It would probably make sense to look for a new credit card, where you can actually do a balance transfer, take advantage of a really, low APR, maybe, around 0% if you're lucky. And then you can, put all your money into paying off your debt. 'Cause remember, there's no interest being charged on it anymore. That means every payment you make is actually going to reduce your debt when there's 0% interest being charged. And you do this, until you, pay off your balance entirely, or until they start charging, interest again. And then you repeat the formula. You look for another credit card company that'll take your balance, with a low APR, maybe no APR, no interest rate at all. And then you can pay it off until you have reduced your debt to a beautiful number known as 0. Thank you so much for watching. I really enjoyed creating this. Make sure to subscribe, make sure to comment, make sure to share with your friends, and most importantly, smash the like button. Yes, there's nothing more important than smashing that like button. In fact, those who smash the like button tend to on average have a higher like score, which is very valuable. In fact, in some cases, the like score is more valuable than the credit score. All jokes aside, hit that like button, but also keep up your credit score. And also, if there's any finance, real estate, investing topic you want me to talk about, please let me know, and I'll happily create a video explaining the topic to you. Thank you so much, and I'll see you next time.